Hey guys, in the previous video of our IFRS learnings, I explained to you how Amazon would record revenue for any product that you purchase online. We saw it specifically for the iPhone that you order online. In that video, I had also told you that because there is a return window which is available for the customers to return this iPhone, and Amazon will have to refund this money to the customer, how would Amazon take care of such a situation? In today's video, I'm going to tell you how would Amazon take care of such a situation. IFRS 15 tells you that you cannot record revenue in your books if you are expecting a reversal out of that. In this case, because you cannot predict the nature of any human being, of how they would behave, whether they would want to return the iPhone or not, you cannot predict that. So how would Amazon record this reversal of a sales? IFRS 15 says that if there is such a situation where you are going to expect a return from the customer, you need to reverse your sale to that extent. You need to debit your sales return, that is your P&L account, which you need to debit, and you need to create a liability. Why you need to create a liability is because, of course, you will have to refund this money to the customer. So you need to create a liability for this. At the same time, the management of the companies also argued that if we are reversing our sales, that is, if we are debiting our P&L, then it is an additional cost that we are recording in our P&L. So the management argued that why we shouldn't reverse the cost of sales also involved of this product that we are expecting to get returned. Due to this, IFRS 15 also suggested another entry that you need to pass now. You need to record a right to receive the inventory back in your books, and you need to credit your cost of sales, which is a P&L account. In this way, you are debiting your P&L with whatever amount that you are going to refund, and you are crediting with the cost of the inventory that is going to come back to you. Now, it depends on companies to companies how they want to make this sales return. They can either record it as a percentage of past experience of how much percentage of the sales has been returned in the past, and they can create a provision at month end for this, or it can be on a case-to-case or a material or a product-to-product basis. It completely depends on companies how they want to record it, but you need to follow the basic guidance of IFRS 15 that you cannot record revenue if you are expecting a reversal out of the same. I hope this video was helpful for you guys in understanding how to record the return scenarios of any product that you are purchasing. Please feel free to give us your feedback in the comment section if you want me to further clarify on this topic. And as I said, if you want us to cover any more topics specifically, please let us know in the comment section. Thank you.